Hi, this is Scott McLeod with Brown Financial Advisory. I just wanted to take a few minutes and share with you what's going on with the markets right now. We're about halfway through the year and we've had some pretty good performance in the US, but there are a few things that are going on that I think are important for you to know, and I'd like to spend just a few minutes talking with you about that. Of course, I'm the president of Brown Financial Advisory, and we have just a few disclosures here for you. And the agenda for the day is I want us to first talk about valuations and how they impact future performance. The next thing I'll talk about is what's happening with the Magnificent Seven, the top technology companies on the S&P 500. And then the final thing is how we're protecting the portfolio using global diversification in order to reduce the valuations and increase the potential performance in the portfolio over the full cycle. First thing is to define a little bit what happens with regards to valuations and performance. As you can see from this graph, there's a relationship between the performance of the investment and the current valuation. So on the left side of the graph, what you see is a relationship where we have the forward price to earnings ratio on the bottom, which is considered a valuation metric for the stocks. And then this is the S&P 500. And then on the top, you see the expected returns. And this is 1 year return. So it's basically saying if we start at a forward valuation of 20.5 times earnings, what would we expect in terms of performance on the portfolio for the next year? And basically, this is a scatter plot. It doesn't give us a whole lot of information for 12-month returns. However, if you stretch that out over a 5-year period, you start to see returns converge around this line, meaning that as valuations increase, 20.5 times earnings is a relatively high valuation metric when the S&P 500 has averaged about 16 over the last 25 years. You can see that the performance converges around this line, and the higher the valuations are, the lower the expected performance. And the downside is that when we have valuations above 20, like it is here, most of the returns fall below the line in the low single digits or maybe even zero range, possibly even negative once you get out past here. So I just want to lay the foundation that there is a relationship between current starting valuations and the future performance. And in this case, you can see that convergence on the 5-year basis. So what does that mean in terms of where the US market is right now? As you can see, the S&P 500 is trading at 20.5 times earnings. And there are a number of different metrics for measuring this, but you can also see from this graph that 20.5 times earnings is a full standard deviation away from the average. And as you can also see, there have only been 2 times in the most recent history since 1994 that we've been at valuations that were higher than this. And also there are different ways to measure valuation. So this is forward PE. You can also see the CAPE ratio, which is now at 34. 30-year average is 27. Dividend yield is only 145 when the 30-year average has been closer to 2. The price to book is 420 when the 30-year average is 3. Price to cash flow is 15.5 when the 30-year average is 11. So you can see that basically when we take all of these different valuation metrics, there isn't anything that deviates from the fact that the market is a little bit expensive right now. In fact, if we go a little bit further, I'll show you what the CAPE ratio looks like. And this is the cyclically adjusted PE ratio. You may have heard it called the Shiller PE ratio. Right now, the Shiller PE is at 35.64, and you can track this all the way back to the late 1800s, and there are only 2 brief periods where we were higher than this ratio, which tells me that tracking back, this is a pretty expensive market. Another ratio that we can look at is the trailing 12 months PE ratio. So instead of forward PE, this is looking at last year's earnings and how does that compare to the current price. We're trading at 28 times earnings. And again, only 3 periods in history where we've exceeded this. This one period in 2008 was because the earnings dropped off so precipitously that there wasn't a good way to measure it. It says it was 123, whereas right now we're at 28. So that kind of gives you a feel for what was happening back then. But these other markets in 2020, the valuations exceeded that. And also in 1999, valuations exceeded that. So by any measure right now, you would expect to say that the market is a little overpriced, overbought, if you will, at least in segments of the market. Now, what does that mean exactly? I'll share with you that the Magnificent Seven those top technology stocks are actually driving this valuation metric and also a lot of the performance of the market right now. For example, if you look at the market today, this line represents the Magnificent Seven and the growth of the Magnificent Seven since 2022, 2023, and 2024 versus the S&P 500, and then the market without the Magnificent Seven. And you can see the results here. So in 21, those seven stocks were up 40%. In 22, they were down 40%. In 23, up 76% and up 21% so far for 2024. The thing that I want to point out is without those seven stocks, right now, the US stock market would only be up 5% for the year. So this is an important metric for you to realize because 5% is a modest return, and it's actually about like the rest of the world. So developed international stocks are up about 5-6%, and same with emerging market stocks, about 5 or 6%. But what's happening here is we have this concentration of stocks in just these very, very few companies, and they are, primarily the technology companies. So you're talking about Apple and Amazon and Google and Facebook and NVIDIA and Tesla. Those are basically driving those returns on that part of the market. And as a result, they're really pushing the market. This is a bad thing for a couple of reasons. Number one is those companies are trading at very, very high multiples, and those multiples are creating additional volatility. And you can see here, the best seven stocks have ranged in performance from, say, 2021, for example, down on the bottom right here. You can see in 2021, 125% to 2%, or in 2022, -65 to -27%. So there's a lot of volatility in those few stocks. And that's not surprising since they're technology companies. And you can see here, the PE ratios kind of define what's happening. As I mentioned before, the long-term average PE for the S&P 500 is about 16. So you can see 28, 78, 27, 46, 38. So these are very, very high PE ratios relative to the S&P 500. But there is one caveat that I would say that makes it a little bit palatable, and that is this PEG ratio. So the PEG ratio is a PE ratio divided by the expected growth rate of the company. What this does is this normalizes the relationship between the price and the earnings a little bit. So it's forward projection. So in other words, you're projecting out for 5 years and saying, what do we think the earnings growth will be for the next 5 years? And these are analyst expectations. And then they compare that to the current price and the PE ratio, the current PE ratio, and it gives a ratio that tells us what they think the forward growth rate will do to normalize the ratio. A good PEG ratio is below 1, but you would expect growth stocks to have maybe a little higher PEG ratio because those PEG ratios are also a little higher PE ratios. So we're seeing Meta at 1.17, NVIDIA at 1.5, Alphabet at 1.59. Only Tesla, Microsoft, and Apple are really trading above 2, and those may be considered somewhat expensive even with their higher growth rates. But the first few look like they could just about justify the PE ratios even with their current growth rates. So that should tell you that while there is some additional volatility, there is also probably some room to run. And you're not surprised to hear that, I'm sure, because a company like NVIDIA, for example, that's so embedded in the new AI revolution, you would expect that company to not really know just how fast they can grow over the next few years. It could be even faster than they think. And so same thing for other technology companies in that space. So I think there is the possibility for that, but it does not negate the fact that there could be extra volatility because of the valuations. So you can see how this plays out over time. So the top 10 stocks, for example, are now trading at 28.1 times earnings. That long-term average for the top 10 stocks is only 20. So you would say that they're trading at about 138% or 38% higher than normal for the average over the last 30 years or so. The remaining stocks of the S&P 500 are here trading now at 17.6 times earnings, with the average only at 15.7 times earnings. So maybe only 112, which should tell you that overall, the market's a little overvalued, but not extremely overvalued. We've got a concentration in these few stocks that really is driving both valuation and performance this year. But those few stocks are in this market that really we don't know what the growth rates might be. So it's hard to say that they're especially bad or especially good. all we can say is that the valuations are a little bit high, and there is a really quite a high concentration. These stocks have continued to grow, and their market capitalizations have also continued to grow. So now, as of May 31st, these 7 stocks account, I'm sorry, these 10 stocks, it's top 10 stocks on this slide, but these 10 stocks account for 35.4% of the market capitalization of the S&P 500. So that means the other 492, the S&P 500 actually has 502 stocks, but the other 492 stocks only account for 65% of the market, whereas the top 10 stocks of this particular slide accounts for 35% of the market. Now, thankfully, if you look down below, the earnings have been growing too. So the earnings of these top 10 companies also now account for 27% of that index. So they're not small companies, and they're not losing money. So this is, the thing I want to emphasize more than anything else is this is not 1999. We're not concentrated in technology companies that will eventually go out of business. In 1999, there was an extraordinary percentage of companies that didn't even have earnings during that period. They never even broke even. That's not the case. These are dynamic companies with great R&D and great opportunities. They just happen to be bid up a little bit high right now. And who's to say they can't justify those prices? But the rest of the market is priced in relatively stable. So maybe it's a little above average, but it's not a lot above average. So what are we going to do to kind of protect against that additional volatility? We're protecting the portfolio through global diversification, and I'll show you what I mean by that. You've seen this chart before where we show the asset class returns across the portfolio. And the thing that you can take away from this chart is that there's a lot of variability in the winners on this. So you go across the top, and there have been periods of time when, say, real estate recovering from the crash in 2007 and 8, real estate was a dominant factor. But the next asset class across this list is U.S. large, and U.S. large was the #1 asset class for the last 15 years by a wide margin, way above global stocks. The problem with this graph, and depending on it for future performance, is that that's not typically how that works. In fact, those asset classes tend to change places, and the ones that were at the top for one period of time are often at the bottom or near the bottom for the next period of time. So what's happening right now is you're starting to see this disparity in valuations and dividend yields. So global stocks have become far less expensive than U.S. stocks, relatively speaking, and their dividend yields are much, much higher. So as you look on the left side of this chart, you can see here that if we track this back to June 17th, the relationship of valuations, price to earning discounts for international stocks versus U.S., international stocks are trading at roughly a 36% discount to U.S. stocks. So if we look at the total S&P 500, international stocks are trading much less expensive than the U.S. stocks. And in addition to that, those international stocks are providing an extraordinary dividend yield. If you look at the current dividend yield for U.S. stocks, it's only 1.4% for the dividend, whereas international stocks are providing a dividend of 3.2%. So if the stock doesn't grow at all, it's still generating a 3.2% dividend yield, which goes into your overall performance. So what this means then is it looks like an inflection point for U.S. stocks versus international, and this has been a long time coming. In fact, if you look at this chart, this shows the relationship of developed international outperformance versus U.S. outperformance. And when you look at the chart, you can see that there's a pretty consistent relationship all throughout the years, where every few years, every 3 or 4 years on average, the international stocks outperform U.S. stocks and vice versa. U.S. stocks may outperform for a few years and then international stocks. And if you look over this period, you'll see that the average time frame is about 4 to 5 years until we get to the most recent period. And U.S. stocks have outperformed for 14 years. Now, this is very unusual. You can trace this back. This is, a 50-year period that we're talking about here. And there's a consistent relationship of international and U.S. stocks one outperforming during one period and another outperforming during the next period. But we've not seen that relationship working over the last cycle. And what's happened now is international stocks are very discounted as compared to US stocks. US stocks are relatively expensive as compared to the long-term averages, and we're way overdue for that shift. Now, there was a brief period that happened about a year ago when international stocks did outperform, but we still fully expect that those valuations will normalize. And when they normalize and the US market starts to normalize, we would see US stocks kind of trailing a little bit, international stocks starting to pick up again. And you can see this reinforced in this chart where you see where the valuations are. So over here on the right-hand side of the chart, you can see the basic asset classes, US stocks, trading here at 20.5 times earnings when the long-term average is 16.7. That's way above the average, and that's including those 7 or top 10 stocks in the S&P 500. But if you look out here, nearly every other asset class, major asset class in the portfolio, emerging markets, developed international, Japanese stocks, you can see those other asset classes are trading at current valuations or below their long-term valuations. So there's that relationship here. And if you believe the first chart, where over a 5-year time frame, you would expect that to normalize. You would say that international stocks should outperform. It protects on the downside because lower valuations tend to be lower volatility. And so it protects on the downside, but it also should give upside potential in the market as well. And you can see the relationship over here. US stocks are really taking off in terms of earnings per share and the expectations, but all of these other asset classes are trending positive too. So we're seeing that contributing to the outlook for the markets. So what do our research partners say about all this? Well, basically what we've done is we pull research from a lot of different sources. And one of those sources is Vanguard, because we trust their research and we know that they do a great job in their long-term research. These are their most recent capital market assumptions that you see here. And as you can see, capital market assumptions are basically the 10-year annual performance based on the March 31st, 2024 capital market analysis. And this capital market model essentially says the US market's going to end up somewhere in this range. US equities as a whole, 3.3 to 5.3%. Value is actually expected to outperform 4 to 6%. Growth, on the other hand, if you look over here, growth is expected to do 0.4% to 2.4%. Why in the world would growth stocks perform like that? Well, it's because the starting valuations are so high that when you look at that first chart that we discussed, you would expect that 5 and 10-year performance would be less. That relationship exists even in the growth stock category. And then you get on to small company stocks and you would expect something similar. Now, once you get outside the US and you start looking at some of these other asset classes, you can see where developed international stocks 6.7 to 8.7. Ex-US 6.7 to 8.7, emerging markets 6 to 8%. These stocks are basically the lower valued stocks that are trading at lower multiples right now, overtaking the US market because of those lower valuations. And again, that relationship of lower valuation stocks overtaking. So it does two things. It provides a little bit of volatility protection against those few stocks that have super high valuations, but it also gives us upside performance in other parts of the portfolio, which we just really haven't seen over the last 10 or 15 years. The longest period that we've seen in the last 50 years that we've seen that type of relationship, we expect that to reverse and expect it to come back to normal. And then the last thing I'll share with you here is just that we have fixed income yields that we haven't had in nearly 15 years. And now intermediate credit bonds, for example, we're expecting to yield 4.7 to 5.7, high yield corporates 5.4 to 6.4, and maybe even higher if we continue with these longer term averages. So the last thing I'll mention to you in our core plus philosophy, of course, we manage all of our client portfolios in a centralized way. So we keep an investment committee that determines the direction of all of our portfolios, and we implement that for every client using our Chief Investment Officer, Josh Lancaster, and I combining to design the portfolio direction. We want to keep a solid core, which looks a whole lot like the basics of the market, including the US market, where we have a substantial portion of the portfolio allocated and have benefited from the outperformance. In addition to that, however, when we see the plus side, we want to take advantage of things like lowering interest rates, boosting bond returns, and lowering interest rates, increasing emerging market and real estate returns, and international stocks with lower valuations outperforming the US stocks in the next cycle. So all of those things combine for our core plus investment management philosophy, and we expect those things to play out well in the course of the next few years. So I want to thank you very much for the time. I hope this was helpful. Please let us know if you have any questions about anything that I've said during the review today. We look forward to seeing you at your next review. And as always, thank you very much for placing your trust in us.